110 highs to the 93 lows, it has not failed. We are still in shorts until they fail. However, it is interesting to note that we are holding a key technical level at the 95.70s. That low could in theory be the wave 4 of a massive ending diagonal in a huge long-term carry trade. And to be honest, to see the US dollar become truly healthy, I would still like to see one more capitulating top, a panic low in the dollar that I've been looking for a long time. And I do believe that if the Fed is successful in their current intervention attempts in the US market, which are arguable that they even do that, but that's another theory, is that the U.S. is a interesting has an interesting central bank, because there are a lot of theories that our central bank actually intervenes in more than just our currency market, or rather than intervening in the currency market, they intervene in treasuries and in the futures market to prop up stocks, to devalue the dollar by making treasuries cheap, or rather Federal Reserve notes cheap, which in essence every US dollar is collateralized by US debt. If the Fed goes on a printing spree, which could be physically printing the currency or issuing more debt, either way it's effectively doing the same thing. When the Treasury when the Treasury is selling their notes, they're effectively selling the future value of the dollar. In other words, China buys a billion worth of U.S. Treasuries. They're effectively buying $1 billion US at the expiration date of the Treasury. Well, not perfectly. I mean, they make some money for it in US dollars. Obviously, they make that rate. But the idea is that in the end, the transaction for any treasury is really just hard currency, and that's how the U.S. does it. So the U.S. doesn't say they go in. The Federal Reserve never says they go in and intervene in the U.S. With the currency itself, but but they have plenty of measures to do so through other assets. And so point being is that we could have seen a major top. I'm not arguing that, because this can be 1, 2, 3, 4 extended fifth wave up in a big completed fifth wave, but it also could be an ending diagonal. So either way, it does fit an ending diagonal now. I can count these waves in 3, and our wave 3 is shorter than wave 1, and for wave 4 or 5 to be shorter than wave 3, which would also be shorter than wave 1, to meet the needs of an ending diagonal, we need to stay below this 123.24 figure. Until invalidated, we do have technical targets at the 120 figure, however, if we're holding the 95s. So something to keep in mind, that if we do see a substantial low in risk appetite form, we do have targets, and we are in measured move longs. S&P 500. We have a lot to look at in the S&P 500, but first I want to look at, and we're going to look at mostly daily stuff. First I want to look at S&P 500, and this doesn't have actually crude in it. This is just the S&P US dollar CAD inverted, and you know what, you can add crude to this and you'd see the correlation right with it, right? We already really looked at that when we looked at US oil, right? Crude and the S&P are clearly correlated. Well, it'd be well, this is all 3. I didn't get it right that time. Oh, where are we? Here we go. But dollar CAD and the S&P have been highly correlated. We used to, at Impulse Traders, take a look at dollar CAD and the VIX, as dollar CAD seemed to have moved more so in line with the VIX than actually the S&P 500. In other words, it moved exponentially relative to the moves. Dollar CAD was following the volatility in the S&P, whereas now dollar CAD seems to be following the S&P price rather than just the volatility. So remember, this is dollar CAD upside down. So the sell-off in dollar CAD correlated with the risk on rally that had happened from the 1068 lows in the S&P 500. And I just wanted to point out that you can use the two and fade their differences and trade the divergence. Although right now dollar CAD and the S&P seem to be moving in lockstep. All right, so our primary count on the S&P 500 right now is from a daily perspective, and this makes the assumption that the major 666 lows, the Jackson Hole, Wyoming lows that occurred in March of 2008, are actually a huge generational low. We do have, can make the argument in the case for we have 5 waves up, and the 5th wave was an extended 5th wave, and that we are now in a seasonally bearish market looking for a larger wave 2. So this would be first wave of the next generational move, and we're looking for, and this could be the big dip. In other words, the last dip before a major wave 3 of 3. That being said, the next wave 3 of 3, it could be it will likely be very slow to start. When looking at this kind of move and this type of generational low, if you look back to the 80s, the crash in the 80s, as well as in 29, it's very slow to start, and the moves aren't going to look very impulsive. In other words, well, wave 1 looks pretty impulsive. It really does look like 5 waves up. I can count it as 3-2, but I'll be honest with you, I really want to call that 5 right now. I want to call it 5 for many reasons, but one being that from the top, I can make the case that we just made 5 waves down, which could be our A wave. So we may see some kind of extended rally and chop now for maybe even through December, January, before in the spring getting a nice big final leg down in a B, C leg down, and in that leg, we would really be looking for the 1000s to the 900s to hold support for that major, what I would call it would be the second degree low after the generational low at 666. This is, of course, our bullish count. And now I want to look at our bearish primary count. And the bearish primary count makes the almost exact opposite. It makes the assumption that we have not seen a generational low, and we are actually, in fact, rallied up in a major into a major 3-wave correction top that is a wave 2 of a major bear market. And if this is true, we're about to see a stock market crash, the likes of which will make 2008 look like child's play. It'll make 1929 look like a blip on a radar, on a radar screen. And in all honesty, we should all hope and pray that this is not the case. The U.S. stock market would collapse. You would likely see the Chinese. You'd likely see China come into an era of utter turmoil. And I say that because if the stock market does seize up and you have a seize up of liquidity worldwide, it's going to affect oil prices would skyrocket, gold prices would skyrocket, food, water prices would skyrocket, and it would, I don't even want to get into what it could indicate. But the count is there, and it is valid until it's not. And if this is the case, we could be heading lower now in a series of either nested 1-2, 1-2, or I could make the case that we just had 1, 2, 3, 4, and then this was an ending diagonal 5th wave, where we'd get 1 down, 2 back up to test maybe 1300, above 1250, very likely, before we have a nice big leg down to test lows. Now I have a secondary bullish count as well. Oh, is this right? Okay, yes. So the primary bullish count, remember, has been 1, and we are now in A, have B and C down in 2. And the secondary bullish count actually could potentially have us complete in our correction into where we saw the low that we could potentially have going forward. Now, the reason I want to point this count out is because ever since the Jackson Hole, Wyoming lows in 2008, the S&P 500 has been trading in a series of what are called extensions. So the extension started about an anchor, if you draw a fib from the high, the anchor high that happens at, I believe, 784, right around 800. If you draw it from that high to the previous high, we never invalidated the 61.8. We went and blew through targets. Post flash crash lows. So now we're talking May of 2010, the flash crash right here. This moved from 1221 highs down to 1060 lows, and bounced back. The lows that occurred around 1,000, I believe the actual low is 1,008. The lows that occurred at 1,008 actually filled and dipped in only 5 points to that same extension, and that same extension is drawn with the same anchor low, right? So we keep the low at the same place, and we just drag the high to the new highs, and we held the 50%. The targets for that were at the 1317s. We definitely went up, filled those targets, were unable to break past them, and now same anchor, new high. We have tested the extension at 1091s twice and held them. We hold these lows, and the S&P 500 has new targets at 1510, and very likely has new targets of 1728 for an extension. Extensions typically, when they finally do break out, they will break out to their 161.8 targets. So we could potentially have seen an all-time, not an all-time, but a secondary generational low before the S&P 500 turns relatively bullish. And I would love, however, to see the dollar rally with stocks, and that the dollar rallying with stocks to me would indicate a more sustainable U.S. economy in the future. New Zealand dollar, very similar level, very, very similar level. Same extensions trade. I mean,